How does co-investment work in venture capital? Imagine being able to put your money directly into a startup alongside some of the biggest venture capital firms. That's what co-investment is all about. When venture capital firms find a promising company, they often look for extra funding sources to grow the business faster. Instead of relying only on their main fund, they invite select investors to join in on specific deals. These investors are usually limited partners, which means they are institutions or wealthy individuals who have already invested in the venture capital fund. The process begins when the venture capital fund manager, called the general partner, spots a good investment opportunity. They then reach out to certain limited partners who have shown interest in co-investing before. These limited partners get detailed information about the startup and have a chance to do their own research. This period of review can last a few weeks, where they analyze the company's business model, market potential, and financials. Most co-investments happen through a special legal entity called a special purpose vehicle. This is a separate company created just for that deal. The limited partners commit their capital to this vehicle, which then invests directly into the startup. Sometimes, limited partners might invest directly into the company's equity, but that can involve more rules about governance and taxes. Once everything is approved, the limited partners usually remain just passive. They don't get involved in managing the company or making day-to-day decisions. Control stays with the venture capital firm or the lead investor. Unlike the main fund, where capital is called over a period of time, co-investments often requiring the investors to put their money in quickly once the deal is ready. For startup founders, co-investments can mean more funding from different sources, which helps grow the business faster. It also opens doors to new investors, including large institutions, expanding their network. Since co-investors put their own money into a specific company, they tend to be more engaged and interested in helping the startup succeed. However, founders should also be aware that co-investments can bring in additional investors with their own rights and expectations. This can sometimes influence decision-making or governance. Overall, co-investment allows venture capital funds to share deals, raise more capital for promising startups, and give investors a chance to target specific investments with fewer fees and more transparency. Understanding how co-investment works can help founders manage their investor relationships and plan their funding strategies more effectively.